So basically, this is the second episode of Let's Grow Together. And the first one was all about career, and it was an amazing hit. People really, really loved it. And that is why we are back with the second episode. And this episode, we are going to talk about kya mutual fund sahi hai. So we see a lot of advertisements about mutual fund and stock market mein invest karna chahiye, everything and everything. But should we invest in mutual funds? Should we get into mutual funds? This is why we have Kaustav with us. Kaustav is an expert in this matter, and that is why we have him. And before I go to Kaustav, let me go towards my two amazing co-hosts. First, I'll start with Shruti. Shruti is, let me give a small introduction about her. She has previously worked with as a financial analyst and a consultant of Citibank, and currently working as a marketing strategist and consultant for tech startups. So, hi Shruti, how are you doing?
Hi, Kalyan. I'm doing very good. And thank you for adding me as a co host. I'm very happy to have join everybody over here. I'm waiting for a lot more people to join because a lot of people were very much excited to join this space of ours. I'm very glad and very happy to have Kaustubh over here. Welcome, Kaustubh. And I would like to introduce my another co-host, Richa. Richa is a PR executive, and she is very much interested in the same topic. So I'm looking forward to have a great conversation with you, Kaustav. Thank you for joining us today.
Hello.
Thanks so much, Rati.
Hello, Kaustubh. Welcome to the space. We are really excited to hear you. And I hope you add some wisdom in all of us. Thanks a lot for coming.
Yeah, thanks, Richa. Thanks, Kalyan, and my pleasure being here. Hello to all the listeners.
Great. Kaustav, I'll give a small introduction about you
Sure.
to my audience. Okay, so Kaustav is a director manager research for Morningstar Investment Advisor. Kaustav also joined Morningstar in the year 2015 as a director manager research in the Mumbai office. Kaustav previously has worked with the Royal Bank of Scotland uh, in the Mumbai office itself, and he was responsible for setting up and managing the mutual fund recommendation platform. He has contributed to the fund research arm for the bank as well. Kaustav holds a bachelor's degree in chemical technology from Institute of Chemical Technology (ICT) Mumbai and a master's degree in management studies from IIM Calcutta. So Kaustav, that's an amazing, amazing achievement. Also, I have had a word with Kaustav before as well. We had a conversation about ESG funds, and it was an amazing conversation. We had a Google Meet, and we discussed all about it. And I asked so many questions to Kaustav, and Kaustav was so patiently answering all of them. It was an amazing, amazing meeting. So, Kaustav, how is your day going?
Firstly, Kalyan, Shruti, Richa, thank you so much for the invitation to speak, and it's really my pleasure. I must admit that this is almost like a first for me in terms of doing a Twitter space. So, pardon me if I'm hoping to really talk about whatever we intended to, but if I'm ever going off track or whatever, pull me back in, and I'm hoping for a very, very engaging conversation. And thanks for the very kind, generous introduction, and welcome to all the listeners. Super excited. Like I said, it's the first of sorts for me in terms of a Twitter space. So yeah.
That is amazing, Kaustav. So I'll jump right to the first question. And my first question to you is that as an investor, let's say I'm a newbie, and most newbies think कि यार म्यूचुअल फंड में क्यों इन्वेस्ट करें हम डायरेक्ट स्टॉक पिकिंग क्यों ना कर ले I can get more returns from it. It's just how a new investor thinks. So why should someone pick a mutual fund?
Right, sure. And I think, Kalyan, that's a very, very pertinent question. And we've had this question time and again, at different points in the market. So, I've been in the financial services industry for more than 17 years now. I've been an investor myself. When I started my career back in 2005, I had exactly the same question, right? I mean, I think all of us sometimes, mutual funds seem too simplistic, too convenient and easy, and you want to look for that interesting, exciting route, and and stocks allow you to do that at times, right? But I think this when I think about why a mutual fund, right? I mean, there are multiple benefits, and I think they've been written about, spoken about many, many times. Diversification. You have a professional manager and all of that. But let me lay some context in terms of, the last couple of years. Obviously, have seen a lot of new investors come to the, young investors who are doing some great work and coming into the market, trying to pick stocks and really get to know the markets, right? We've obviously had a great run in the past couple of years, after the COVID crash, and then the markets have really gone, back up quite sharply. And typically this is what we've observed when markets are fairly bullish, been, at least for a large part, been a one-way street until more recently, where you've seen volatility. Uh, there is that perception that, look, I can just buy maybe a couple of stocks, names that I'm comfortable with, and I can make more money. Why do I go to a mutual fund? But the fact of the matter, and this is hard data, right? I mean, even in the more recent time. So when I just look at the broader, say, the BSE 500 index, which has probably done like 18% or over the last 3 years, which includes that crash of COVID and recovery since. Um, when I just break down the stocks within that index, right? And this is the interesting bit, right? So the index is at 18%, which is a pretty healthy number. Obviously, I mean, that's not something that you would expect. I mean, it's been a good time in the market, but even then, almost 25% of the stocks, if I just think about the index constituents, gave a negative return over this period of time, right? So that's some hard numbers right there. So you had a 1 in 4 chance that you picked a stock and that actually lost money for you rather than making this fairly interesting return of 18% per annum. If I extend that number, right, and I think about how many stocks couldn't even meet, like, if I just put money in an FD or a debt fund and made safe returns. So almost 1/3 of the stocks over this 3-year period in a market that's been so good couldn't even make a FD return, right? And 2/3 of the overall stock count did not beat the index, right? So you have a 1 in 3 chance that you can potentially beat the index. Uh, so the point that I'm trying to make is that, yes, there are opportunities that you can potentially really pick that exciting new stock or a multi-bagger that runs up significantly, but the probability of you doing that and the effort that you have to make, to do that on an ongoing basis is I mean, the probability is low and the effort is really, really high, right? So I think that's the point, that you could do that. Maybe it just happened that you could identify certain stocks, so you need to do your groundwork and do all of that. Then the second leg becomes almost like timing, right? Because I mean, if you get into a stock too late when it's already run up quite sharply, you might be giving away a bulk of the returns that didn't come in. But when you get into a fund, the whole idea is that you have a professional manager who's really diversifying your investment opportunities. So while it sounds boring of just buying a fund rather than vis-a-vis, getting into a stock, but in most of the times, and again, I've also learned the hard way that sometimes it's just easier to buy a fund. And over the last decade, I think I've purely gravitated towards just owning funds rather than stocks because it's just so much easier, much less hassle. Yes, if you want to do research on your own, it is exciting for sure. But I would say that always make sure that you're not getting in on any news or hot tip. Make sure you're doing well thought out research if you really want to buy a stock. Otherwise, funds are a great way to take exposure to the Indian economy and the markets.
You have summed it up pretty well, Kaustav. Thank you so much for giving this insightful answer. My next question is related to the SIP investment. I would like to talk about that and its significance. So, Kaustav, I want to ask you, like a lot of retail investors like us,
Mm-hmm.
the question is from that perspective. So, how, as a retail investor, I can do SIP investment effectively?
Right, sure. So, there are a couple of, and I think that's a very important point that you raised, Shruti, because when you think about the whole concept of, systematic investing, right, the idea is, I mean, there are multiple benefits when it comes to it. So the first fact, and again, I'll share an interesting study that we had done last year, uh, in terms of, the old cliche that we talk about, right, that time in the market is more important than timing the market. Let me back that up with some data. right? So we ran an analysis of the monthly return of the index versus cash. So basically, what we try to do is that, okay, if over the last 10 years, that's 120 data points, right, on a monthly return basis, can we put the best performing months, basically in a descending order, so the best month on top and the worst to the bottom, and we're comparing this with, just like an FD or a liquid fund return. How many months that you knock off, which basically means that if you were not invested in those number of months, your return would have been lower than cash, right? The number was staggering. And this is again something which is not just prevalent in India, but this is true for even global markets. The number was less than 10%. That means only 11 months out of the 120 months actually accounted for the entire outperformance of the market versus cash. So, when we talk about time in the market is more important than timing the market, that's hard data for you, because if you as an investor miss those 11 good months of performance and this is just on the index, right? You would have been better off just staying in a bank fixed deposit, right? So, and no one knows when that time's going to come, right? It can come tomorrow, it can come 3 months, 6 months, 1 year, 2 years down the line. We know the markets are a strange animal. And that's where SIP has become a very powerful tool, that without having to worry about that, hey, should I be entering the markets right now? What should I be doing? You're just systematically putting money, into the markets at every, at a preset sort of frequency. And you're not that, because when human decision making, it is always exposed to biases, right? Because you'll always say, oh, maybe market's going to fall more, let me just wait. It may or may not happen, right? But the SIP will put that on autopilot. That's one. The second, and probably not that well appreciated fact, and I wish someone had told me this when I started my career, is that SIP is a beautiful behavioral hack, and I'll tell you why. Because when a lot of us who are salaried, right, you're getting a monthly paycheck. Every time when you think about investing, and especially when you're new to the workforce, you're earning for the first time, you're quite excited, right? You want to go out and eat, watch movies, enjoy, buy, clothes, expensive. Great, you should do that. But the challenge that becomes is that investing or saving takes a back seat, and after you've done all of these expenses, then you're like, hey, okay, this much left, let me go and try to invest it, right? Now that can be suboptimal, and what I urge everyone to think about is, can we flip this equation? So the equation that I'm talking about is that in the traditional parlance, we've always used that savings is equal to income minus expenses, right? So whatever is our income, and after what we have spent, whatever is left is our saving, and we perhaps invest that. Can we flip that equation? And SIPs help you do that. That expenses is equal to income minus savings, right? So we've just made a very smart shift. We're saying that first we are fixing our savings, aka investing, and then we'll decide how much we can spend, right? And no one's saying that don't enjoy life and don't save everything, but do have a saving goal in mind and start early. And SIP allows you to do that. So that behavioral hack, once you set that in place, more often than not, you will make sure that you're saved enough to have that money available for SIPs on a monthly basis. And and then we all know the power of compounding. You start early, 15, 20, 30 years down the line, you're going to be sitting on a huge amount of money that you'll be thanking your stars that we started early and started investing very smartly.
That definitely answers about a lot of things, and about the SIP, I believe a lot of people have gotten good insights. Adding to that, Kaustav, I would like to ask you what to do with our mutual fund holdings when the global sentiment of the market is negative. Like recently, COVID was going on, and then, for example, a war is going on or some recession happens. So, in that situation, what to do with our mutual fund holdings?
Sure. Again, I think a very, very important question, Shruti, because a lot of people, especially when COVID crisis hit, were caught unawares on two fronts, right? One is, people probably could have who lost jobs, and they didn't have any emergency fund. So I think the first thing, learning for all of us, is that have an emergency fund available that you can dip into any point of time, right? An emergency fund should be in an investment class that is almost close to zero volatility. Why is that important? Because if you're putting that emergency fund in equities, and equities tomorrow is down 30-40%, what we saw during the COVID crash, your $100 has become 60, $70. That's not ideal, right? So you want to create that emergency fund and perhaps park that away. And this can be about 6 to 12 months of your expenses, so that, if there's anything untoward that happens, you have this money available to you at any point of time, in an asset class that is not really going to drop. It's not going to see great returns. I mean, what equities can give you, but at least it'll be sort of reasonably safe in terms of a capital value, right? Insurance, that's the other thing that people want to do, which is important, especially health insurance, life insurance, something that you want to do. But beyond that, any excess money, you have to think about, when do you need this money, right? What is the purpose of this investment that you've made? Like, if you had an existing mutual fund portfolio, uh, do I need this 6 months down the line? Do I need it 3 years? Or this is money that I'm just going to leave aside for 20, 30 years down the line when I decide to retire, right? That will kind of decide about what you want to do with your investment. And like you rightly said, there was obviously a lot of negativity, a lot of uncertainty in how the global economy, the Indian economy is going to pan out. But if you had that long-term horizon, uh, I wouldn't be too perturbed by staying invested in an asset class like equities, because we've seen drawdowns like this. I'm referring to the COVID drawdown. This has happened in the past. Be it during the global financial crisis and several other times, right? So and the markets have come back up. So it's not. I mean, if you have a long-term horizon, absolutely no problem. The challenge comes is if your horizon is very, very near term, and ideally then you should have already been allocating money into the safer asset classes. For instance, you had a goal, and this is something that we've spoken about at length. That when you think about goals and you have a goal, when you're approaching a goal, always cut your volatile exposure and move into asset classes that can be less volatile. It could be fixed income funds. It could be interest on a bank deposit, a short-term deposit. But basically, so that there's certainty on the capital that you need for a goal that you need to meet, right? It could have been an education payment that you needed to make, or home you wanted to buy, or whatever it is. The certainty needs to be there. So I think it is very, very situation dependent, depending on what is your investing time horizon. But if you have a long horizon, I don't think, whatever uncertainty, people talk about overvaluation in the markets, uh, obviously what the monetary authorities across the globe are doing, uh, those are, I would say, short-term aberrations. And, we shouldn't really dither away from our final goal of that. What is that money required for? I think that's the question everyone needs to ask, because we're investing with a purpose, right? It's not investing just to okay, it's fun, let's make some returns. There is a reason behind why we want that money to grow for us. Goals could be different for different people, but the point is that we have some sort of a goal, and if we don't, we should think about what they should be. So I think that's the moot point. And that's how I would tackle any portfolio construction or review, in terms of how do I build it. Time horizons matter a lot.
Thank you so much for this like elaborative explanation. Adding to this, there are two situations. Either you are getting a monthly paycheck, so you can invest in SIPs on every month basis. But
Mhm.
what if I have a lump sum amount? For example, I have 1 to 3 lakh rupees in my hand right now, and I want to invest it. So, how you suggest to invest it? Like, should I invest everything in mutual funds, or what should be the best strategy according to you?
Sure. So again, Richard, the decision really depends on, when do I need this money back, and what is the purpose of this money, right? So I'll give you a couple of examples. So, if you have, this is money that, okay, you got maybe perhaps a bonus, or endowment, or a gift from someone, and this is money that you really don't need for the next 10, 15 years. You can actually stagger that money over the next 3, 6 months, and invest into equity mutual funds, right? Because that's money you're not going to touch. You don't really need it, so you're fine. You can get into a more sort of volatile asset class such as equities. And again, the route, like we spoke about, equity mutual funds are a great tool to do it. But if you have the wherewithal and you want to pick some direct stocks, feel free. But the caveat is that you must be doing your own research and not relying on tips to do that, right? Uh, but if you have a short horizon, if that money is, for instance, you want to buy something 1 year down the line, right? And that's an urgent or an important need. It's not a want. then I would definitely urge that you can use instruments such as fixed income mutual funds, which will give you a certainty of that, you're not going to lose your capital. You're not going to make supernormal returns in it, but you will get an appreciation. At the same time, you won't lose your bank balance in terms of worrying about that, hey, how am I going to meet my goal because I invested this money and the value is down 20, 30, 40%, right? So I think that's what you need to think about. And obviously, if you have, horizons in between, you can use a set alert. So I'm giving two extremes, but you can always, there are various kinds of mutual funds that exist across asset classes. In equity, debt, you also have multi-asset funds, and you can really asset allocate depending on your investment horizon and also your risk appetite. I think these considerations are something that investors should need to think about before they make these sort of decisions.
That is insightful, Kaustav. So just let me talk to the audience here. Okay, so I have attached one thread you can see at the top. If you guys want to understand any terms, terminologies, if you don't understand, you can just go to that thread. You can just check it out. I have arranged it A to Z so you can figure out what we are exactly talking about. What is AMC? What is AUM? All those stuff. Okay. Also, you can ask your question in the comment section, and also you can raise your hand, and let's go to the first listener, Saurav. Yeah, Saurav, go ahead. You can ask your question.
Thanks, Kalyan, for opportunity. Hey, Kaustubh, sir, I just wanted to ask about there are certain concepts in the market. Some are mutual funds, some are ETFs, and some are index funds. So, what's the difference in all these terminologies, and what is the best tool of investment for a Gen Z who is age 20 to 30 years and who is looking for an investment period of 10 years, let's say lock-in period of 10 years. So what will be beneficial, ETFs or index funds or mutual funds?
Sure. So I think, thanks for your question. And I think a very, very important sort of point that you've raised. So let me just quickly touch upon. So mutual fund and, so basically an actively managed mutual fund, right, is where you would have a fund manager take calls on, it could be on sectors or stocks. And when you compare it to the index, there'll typically be overweight, underweight calls. I mean, just for argument's sake, instead of holding 8-9% in HDFC Bank, they could potentially, underweight that and, be more positive on ICICI Bank, or be more positive on financials versus technology. So I'll go underweight technology and I'll overweight financials. So that's what we call an actively managed fund. And this is mostly an actively managed equity fund, right? An index fund would basically mirror an index. So you can pick, say an equity index, say the Nifty 50. It will mirror the constituents of the Nifty 50 in totality, right? So if stock A is 5%, it will buy 5%, and similarly, it'll own those 50 stocks in that proportion. It'll look to mirror the index, so basically close to mirror the performance of the index. Obviously, there's an expense ratio that's involved. That's what an index fund would do. An ETF is similar, just the platform and the way it works is different because, typically mutual funds, either you can, buy, redeem, or, now there's obviously a dematerialized format also, but an ETF is necessarily traded on the exchange, right? So you can potentially buy, which is again based on an index. Just the structure in which an index fund is, it's very similar to an actively managed fund. An ETF would be on the exchange, so you need a demat trading account to kind of, trade in that. But it'll, again, the ETF's intention is to mirror the underlying index. So it could be a Nifty 50 or a BSE Sensex or BSE 100, whatever the index is. And again, you can have different kinds of asset classes, right? So you could even have index funds on, in fact, that's a very popular category now where they customize debt ETF indices that are being created with a certain maturity in mind, so that if you have a fixed goal, say 5 years or 3 years down the line, you want a fairly risk-free option, then you can just get into these sort of funds. So I think, these are the nuances. Now, the other point, and which is a very important sort of question that you raised, Saurabh, is how do you, as a new investor, who's got a time horizon, which one of these do you pick, right? Now, traditionally, what we've seen is, and I'll specifically talk about the equity side of things, actively managed equity funds in the past have enjoyed a significant amount of outperformance over the index that has happened. But in the recent years, we've seen a fair bit of shrinking. There's obviously market maturity coming in. SEBI's also created categories which have kind of tightened the realms in which these funds can operate. So the flexibility in that sense is reduced slightly. So that has reduced the alpha that potentially certain categories of funds can generate. And herein lies the issue with the new investor, because there are so many funds now that are available, right? In terms of fund categories, and within a category, you have 30, 40 asset managers that are offering their own version of that fund. Then it becomes very challenging at times for a new investor that what do I do? Which fund do I pick? How do I go about it? And that's what we call choice paralysis. When there are too many choices, sometimes an investor just doesn't make a decision at all. And that's the worst thing you can do for your portfolio, right? Because like you said, if you have a 10-year investing horizon, it's a great time to invest in the equity market. So, you can, you might see some volatility over the next few years, but, over a 10-year horizon, data has shown us that you can make a reasonable amount of return as long as you stay invested. But if you have this face this choice paralysis, then the easiest thing to do, and that's where index funds and ETFs are so easy, because you're just buying the broad market, you're just buying the index. You don't have to think about, should I buy large cap fund of AMC1, AMC2, or AMC3. I just buy the large cap index fund or the ETF, and I stay invested over the period of time, right? So it becomes a very simple choice to do that. These are typically cheaper to own in the sense because the expense ratios are marginally lower or much lower in certain cases, especially like the ETFs. The only thing I would guard against, and this is very important, when it comes to trading ETFs, we've seen that sometimes the traded or the quoted, the bid-ask price that you would see on the exchange are sometimes completely out of sync with what the underlying price of the NAV of the NAV of the fund is. And thanks, Kalyan, for sharing these very useful terms to all the listeners. And that can cause a dissonance where, say you want to buy it, but it's trading at a 4-5% premium. So you're actually effectively buying something 4-5% more expensive. So you just need to be careful. But otherwise, an index fund does not come with that baggage. You can just, apply for that, directly through the asset manager or various platforms of your direct plans. You can just buy the index fund of those.
Yes,
Thank you
sir.
so much, Kaustav. Yes,
Yes.
Saurabh. Does that answer your question?
Yeah. Another question adding to this only. Sir, if we decide to invest in mutual funds, so which category of mutual funds should we pick? Means, should we pick small cap fund or mid cap fund or large cap fund or multi cap fund? Flexi cap fund जो होता है वो. From
Sure.
a 20-year investors, means 20-year-old investors point of view.
Sure. That's again a very, very valid question, Saurabh, because traditionally what we recommend, even if you have a very long horizon, right? And like I said, different asset classes and different categories of funds will also have typically a minimum ideal investing horizon. So, if someone came, say, with just 5 years, wanted to invest in equities, you would traditionally tell them that, look, stick with, the large caps or the blue chips, because, those are the ones, while, the returns over a long term might not be as attractive as a mid and small cap, but the probability of drawdowns will also be lower as compared to those, right? Now, as the time horizon expands, you would gravitate towards thinking that, hey, maybe can I own the entire allocation in mid and small caps because I have a 15-20 year horizon. That's not really the case, because when you think about the principles of portfolio construction, what you would want to do is typically these large caps would form an integral part of any investor's portfolio, no matter how risk loving that investor is. But we'll increase the amounts of, say, mid and small caps, or the more attractive asset classes which could provide great long-term returns but can be extremely volatile in the short term, pad that to the investor's horizon. So you can actually do a mix. But I would definitely recommend, if you're looking at a pure equity portfolio, at least 50 to 60% should still be a core large cap holding. And then, you can buy remaining in mid and small caps if you have a very, very aggressive risk profile. And again, that's very important when you think about your own risk profile. Investors need to understand there are two type elements or two dimensions to risk, right? There is the ability to take risk, and there's a willingness to take risk. And let me just quickly talk about what that means. The ability is, if someone says, I have a 1 year horizon, I want to invest in equity, then his ability to take risk is almost close to zero, because you need that money after 1 year. there is no way that you should be coming in the equity markets because the chance of you losing money is as high as you making money in that, and that's what historical data shows us, right? The willingness is just the investor's own psyche. That I might have the ability, but can I bear drawdowns? I mean, imagine if you're an investor, you invested just before COVID 20, in 2020, and you saw your portfolio value erode 30-40%. What would your reaction be? If your willingness to take risk was limited, you would probably just sell everything lock, stock, and barrel. Ki, मैं fixed deposit में अच्छा हूँ, जितना पैसा है, let it just be, and I'll just get all of that money into a fixed deposit. Then the willingness to take risk is almost close to zero. But if you're someone who understands this, can take on greater risk, then you would add some of these more volatile asset classes. So it is very, very investor specific and dependent. And every investor should ask these questions and ponder over it on their own. That what is my ability, which is important, which you can assess by what's your time horizon. That can drive a lot of ability, but that's not the only one. Your financial situation also can decide what is the ability to take risk, but more importantly, what is your willingness to take risk. Can you stay invested for the long term?
Yes, adding on to that only, whether
Saurav, just a minute. Yeah, it's another question, right?
yeah, last one only. That's
Okay. Just keep it short, okay? Yeah.
yes, sir. We see a lot of baskets and small cases around here today. So, are small case worthy investing instead of mutual funds?
So again, will depend on the kind of small case you're trying to get into, because a lot of them are thematic based, or based towards so the question is that what are you again trying to get by doing that, right? So typically the way we look at portfolio construction and think about it, always have your core allocation in the most diversified sort of buckets, right? So could be large, mid, small, diversified funds within that. If you have some extra capital, which you could call as risk capital, and you want to play with it, then you could play some of these themes, right? That you want to play a small case, which is say, auto or momentum based, which is a factor based investing, all of those, but play that only with a small part of the capital, which you think that, okay, let me just dabble in it and see what I can do. But you shouldn't be able to, it shouldn't break your bank completely that, something goes wrong with that. I think that's the idea. Diversified mutual funds can be a great way to build the core of your portfolio. And then if you have additional capital, it should be only a limited portion of your overall portfolio. It's something that you could potentially dabble in that. I mean, that's my take. Obviously, different strokes for different folks.
That's great. Thank you so much, Kaustav, for answering that. Abhishek, you have raised your hand. Please go ahead with your question.
Thank you so much, Shruti. So, Kaustubh, I would like to ask one question around goals. I think most of the population in who lie under millennial and Gen Z category, sometimes we don't have specific goals for investing, and what we end up doing is we end up sort of throwing a bucket of money into something which was not worth anything at the end of the day. So I would like to probably from your experiences, you must have seen a lot of clients coming in where they probably when they started entering the markets, probably they felt like it was a little late and they could have started a little earlier, just because they didn't had any goals in mind early on. So I would just like you to highlight the point, how to go about investing in case if you don't have any goals in your mind, and how fine is it to start off without any goal in your mind, and then later on how that can be capitalized into something which can turn on to be turn on to a real good thing for us as an investor.
Sure. Absolutely. Again, I think a great question. And, there are a couple of things to it, right? So when you think about goals, and I completely agree with you that, when you're a new investor, you're just starting off, there is no way, and it's true for everyone, that there's no way you're going to have a visibility or a pulse on all the goals that you're going to want at any point of time, right? So I think the first discipline that you need for everyone who needs to set this, people that invest regularly start on day one, right? So even if you don't have a very, very clear-cut goal in mind today, but at least start that journey by investing, because the most obvious goal that everyone will have, and it might sound, for someone who's just 22, 23, it might sound like, oh, there's so much time for it, is retirement, right? I mean, all of us think about that. Look, at some point in time, we're going to stop working, and probably cash flows are going to dry up, and we want to have a retirement corpus that's available, that we can live life comfortably, right? And enjoy life that we did when we were earning. Now, we don't know when that's going to happen. There are people today, in today's day and age, probably retiring when at the age of 40, 45, and there are people still at the age of 65 working. So again, different perspectives for different folks. But the idea is that that's one common goal that everyone will have, right? You don't know when it's going to come, but it's going to come at some point in time in everyone's life, right? Now, again, it's not like you have to, have a very concrete plan and have those numbers in place that I need XYZ amount of money on day one. But the point is that if you don't start that journey today and you're late to the journey, you're always going to be playing catch up, right? And again, like I said, I learned this myself probably the hard way, because when I started working, and mind you, I was working in the financial services industry. I probably was not that careful with my money in the first couple of years of my career, because I thought, hey, there's so many years to go. Let me just, spend. I didn't really invest that methodically, right? So, and that's the point that I was making, that if you can just think about and pen down that, look, this is the minimum I want to save from my paycheck every month. And could be 20%, 30%, 40%, depending on what you think. But start, right? And again, this is a number that a lot of people talk about. And let me just share some very quick data. What we call about the power of compounding. If you started at the age of 25, and investing 10,000 bucks a month in the market, through SIPs, till the age of 60, right? So, and assume that you made about 10% return on average on your investments there. So you invested aggregate about 42 odd lakhs over this period of time. Your portfolio value would have been about 3.57 crores, right? Sounds like a lot of money, but maybe in that day and age, not enough, right? But if you delayed your investing, you said, let me enjoy life, abhi bahut time hai, investing main chalu karunga, and you start only at the age of 35, so 10 years later, right? You're like, now I'm going to be more aggressive. I would have started at 10,000 bucks 10 years ago, but now I'm going to, more than double that. I'll start with 25 grand, for the next 25 years on a monthly SIP. So you would have aggregate invested about 75 odd lakhs in that period of time, but your portfolio value would actually be lower at only 3.24 lakhs. So the point that I'm making is, the more you delay your investing journey, the worse it's going to become, or you're always playing catch up. So I think that's the important thing. You may not have a very concrete goal to start with, but nothing stops us from at least keeping money aside for a rainy day, for a goal that can come in the future. And as that goal starts crystallizing, then you can look to reshuffle or rejig your portfolio to shape it in the means that you want it to meet the goal. Because perhaps 2 years down the line, you're like, what, I want to buy a house, or maybe I want to buy a car, which you didn't think about 2 years ago. And then you'll need to figure out that how do you create the cash flows to pay for that, right? But start, so that you have the capital available and you're starting that journey very soon.
Thank you for the answer. That's a good one.
Thank you so much, Kaustav, for answering that. It is definitely very important. Thank you so much for sharing your experience and insights. Keeping money aside and then utilizing that capital later on, definitely it is something which, I mean, a lot of people misses out early in their during the early years of their career, but we all of us should keep that in mind. We have few questions in the comment section. Kaustav, I would like to ask one that is
Mhm.
from V. The question is, which type of debt fund is good for parking funds for 3 to 6 months? Money market fund or liquid fund or low duration fund? After that, we will take next question from Aditi.
Sure. So I think, if you have a 3-6 month horizon, honestly, I wouldn't worry too much about, the yield of the portfolio. Typically, a liquid fund will do the job very well for you, because, when we think about risks in debt funds, there are two types, right? There's interest rate risk, and there's the credit risk of portfolios. Obviously, a liquid fund will have close to zero credit risk, only hypothetical credit risk. There are other kinds of funds that can probably give you slightly higher yields or returns, be your low durations or your ultra short durations. But they could have a minor element of what we call interest rate risk. In an environment where interest rates are going up, the bond prices, will fall, and that could cause some what we call a market impact on the price of the bond. It's not going to be substantial, but I'm just highlighting that. So if you want absolute reasonable, close to reasonable certainty in the value and the returns of your portfolio, I think liquid funds are great. But if you don't mind taking an additional, it's not a great risk, but just an additional kicker for that yield, then you could also potentially look at low durations or ultra shorts. Just the thing on that, make sure that when you're looking at it, always look at the underlying credit profile of the funds. There will be funds that could potentially have slightly, higher going down the credit ladder. And again, what works for you is, typically just stick to the AAAs. I mean, for that short, the yield kicker is not going to be something that you're really going to benefit from much.
Thank you so much, Kaustav, for answering that. Thanks a lot. Aditi, please go ahead with your question.
Hi, thank you so much for asking the question here. And first of all, I'd like to thank Kalyan, Richa, Shruti for hosting this. And Kaustubh sir, your advice has been insightful. So my question to you would be, how does the ownership work in mutual funds? And this is because you used to buy generally mutual funds through brokers, so you would store it there, and if you're buying stocks, they rest in a demat account, right? But if I'm buying mutual funds from Zerodha, for example, or let's say there are apps by various banks, so ICICI Bank has an app. So how do I know that I have those, mutual funds? Like how does the ownership, what is the proof of ownership? Let's say if the intermediary, for some reason, in an extreme case, goes bankrupt, for example. So how does ownership work that way for mutual funds?
Sure. So Aditi, thanks for your question. I think that's a very important question. So I think the first thing is that your proof of ownership is that there's like a folio and units allotted to you in the mutual fund, and I must tell you that in terms of regulations, mutual fund regulator, obviously SEBI, has extremely well regulated market. So even if you're an intermediary, I mean, either there are very stringent capital requirements that come in from for the parties floating a mutual fund. But more importantly, your money is not going to go anywhere. So even if say there was an event where the sponsor of a mutual fund is probably going through some financial trouble, your units and everything is well protected, and you'll probably have the takeover of that those schemes of the fund from another mutual fund or whatever. So there is absolutely no worry about the units that you own. They're against your name, and in fact, you can always hit the NSDL CAS data to see what are the folios that are against your name, so that you make sure that. So it's a pretty very well tightly regulated industry, and there's really no worry about that. Your money could disappear, because the folios are with you.
Thank you.
Thank you so much, Kaustu, for answering that. We have Agam here with us. He have some question. Agam, please go ahead with your question.
Sure. Thanks, Shruti. So, hi, Kaustav. So, my question is that it's quite simple. Well, so should I hire a financial advisor for myself, or any consultancy, or should I do my own research and then invest into mutual funds?
Sure. Hi, Agam, and thanks for your question. And I think again, a super important question, because what we've observed, and again, let me share a very recent study that we did, and this is what we call mind the gap. And let me talk about what that study really means. What we try to do is look at what is the gap between what the fund has returned over a period of time versus what the average rupee invested in the fund has made, which is called the investor return, right? And what we found was that over any time period, 3, 5, 10 years, especially in asset classes, say like equities, there was a significant gap that existed between fund return and investor return, right? Why does that happen? That happens because a lot of times investors tend to chase performance and come into a trend or come into the markets too late, probably exit too early, or chase very, very trendy funds. So let me give you a live example of that. Technology as a sector did exceedingly well, in the years 2020 and 2021, right? And this is amongst the best performing sectors during this period. But a lot of money that came into tech sector funds actually came towards the fag end of 2021 and a large part in 2022, looking at the past performance of the funds, the IT sector funds, right? Now, the challenge of that is that the performance has already been delivered. In fact, this year, it is sitting on significant negative returns. But the investors didn't enjoy that performance, right? Because they came in too late. And now they're actually staring at flat to negative returns depending on when they came in, and that's the investor behavior gap that comes in, right? So why am I making this point? Because a lot of times, and that's where a financial advisor can be very, very helpful. Now, if you have the time, you have the understanding, yes, by all means you can build a DIY portfolio, and it's honestly a little bit of time you allocate, you can do it, because some of these things are very simple. Like we were talking about, that if you have a long-term horizon, you can just buy an index fund and practically do nothing. Just stay invested, keep investing regularly, and you can make a fair bit of money. But that doesn't work in reality, because we're humans, right? We're humans, and we will make impulsive decisions at times. That okay, now market's just looking crazy, I want to get out, or maybe markets. A lot of people thought after the COVID bounce back, they were waiting on the sidelines for very, very long, thinking, okay, market will come down, then I'll invest, and they just kept waiting, right? And that's where a financial advisor, and we call them more like behavioral coaches, can help you as an investor decide what are the investment avenues that you should be focusing on. What should your portfolio look like? So we spoke about the goal planning, the financial planning. They can help you kind of draw up those plans, be your behavioral coach, so that once this portfolio is being built and you are panicking or whatever, they can handhold you through these times. And we've seen a lot of advisors do that very successfully. Investors who are saying, let's get out of the equity markets, it's looking overheated, just stay invested, right? At the same time, also rein in your exuberance. Like, I've spoken to a lot of investors who are asking that what happened. I invested in IT funds and the fund's done well over the last 2-3 years, but I have made no money. I've lost money, in fact. And that's the challenge, right? So you have to rein in both the pessimism and the exuberance. And sometimes it's always good to have this, financial coach, behavioral coach to help you do that. It's useful for all. So I think that's the idea. By all means, you could potentially do it yourself, and a lot of us do that. But you have to, spend time and kind of attune your mind to do that. Yet you, potentially could be susceptible to some of these biases. So advisors can play a very, and have been playing a very strong role, in helping investors kind of just guide them through these, turbulent times.
Sure. Thanks a lot, Kaustav. I think I'll start with the handling advices from one investor, and then gradually, as I study more about this, then it's gonna be a good. I mean, it's gonna be a great portfolio. Thank you so much. It
My
was a
pleasure.
great
Thanks.
insight.
Thank you, Agam, and thank you, Kaustav. Now, I'll ask you a question. Even though you have touched on the topic of risk appetite, I just
Mm-hmm.
want to ask you dedicatedly, ki, for example, if I am an investor and I'm new to the markets, and I saw that ki small cap mutual fund में बहुत अच्छे returns मिलते हैं, but
Mm-hmm.
I don't have that kind of a risk appetite. I have a low risk appetite. But even though मुझे समझे बिना उस चीज को, I started investing in a स्मॉल कैप म्यूचुअल फंड, जहां पे जब रिटर्न्स के साथ रिस्क भी बहुत ज्यादा है, एंड नाउ बिकॉज ऑफ दैट आई एम लूजिंग माई स्लीप एंड दिस इज रियली रियली टफ फॉर मी. सो हाउ शुड वन अंडरस्टैंड अ रिस्क एपेटाइट? कैसे समझे उस चीज को कि लार्ज कैप पे लगाना है, मिड कैप में लगाना है, स्मॉल कैप में लगाना है, या इंडेक्स में लगाना है?
Sure. So again, I think a very, very important point, Kalyan, and I did briefly touch upon it, but let me just elaborate on a few points. So, like I said, there are two dimensions to risk appetite. the ability and willingness. And many times we've spoken to investors who who have great willingness to take risk. That like I said, कि, boss मुझे सब small cap funds में ही डालना है. But when we ask them, what's your investing time horizon? कब तक पैसा वापस चाहिए? They're like 1 साल 2 साल, right? So the ability is just non-existent, right? They don't have the right time horizon. In fact, they don't have the right time horizon for equity investing at all. So the ability to take on, say equity risk is almost zero, right? Then so the first thing when you think about the ability, and that's one dimension of ability, there can be other elements to it in terms of your financial situation. Now, a lot of times, people use this very simplistic formula saying that, look, if you're young, you can go fully into equities, and if you're a retiree, then maybe you should not invest into equities. That's not always a one size fits all solution, because it depends on the financial situation of that individual. You could be a 20 something with a long investing horizon, but you could potentially have uncertain goals or monetary needs in the interim, and that's why you can't be very aggressive with your investing horizon. Whereas you could be a retiree who's got a huge sum of money because you invested very wisely. You're probably drawing a pension, or you have a large chunk of money that you can earn a fixed return out of, and there could be a certain amount of capital that you could put into equities also. So it depends on the financial situation of the investor who's coming in, right? That's the first dimension of ability that every investor needs to assert it. I think time horizons, I would ideally say, minimum 5 years is, we shouldn't think of equities anything less than 5 years of a pure equity sort of exposure for sure. 7 to 10 years is where I would start thinking about, mid and small caps. And, people might think that I'm being very conservative, but there's a reason for that, because we've seen periods of time, and, we know that history, while it may not repeat, it does kind of play out in that sense, that there have been periods where for long periods of time, small caps or mid caps have made no money, right? In the most recent time, obviously, we've seen that small cap, mid cap funds have done exceedingly well. But if I just go back a few years, right, if I go back to 2018 and 19, especially small caps, saw a huge amount of drawdown when the rest of the market wasn't really actually drawing down that significantly. In fact, marginally positive, right? That's because small caps had peaked in 2017, and then you saw the sharp correction. So the point is, someone came in 2017 saying, hey, look, small caps have done so well, let me just invest, I'll make the same amount of money. The challenge is that they would have seen a huge drawdown, and if they panicked and got out, because or they needed the money in the next 2 years, they probably had a huge shortfall in the capital, right? So I think you need to extend that time horizon, and they can be great wealth creators, but you need to think about it that when I'm getting in today, have a minimum 7 to 10 year horizon when you're thinking about small caps, right? So that's the ability. If you don't have the ability to hold for 7 to 10 years, perhaps you don't want to get into small caps at all. The second is a willingness, which is, are you willing to take that risk? Because maybe your DNA just doesn't allow you to do it, right? So like I said, if you're seeing a 40-50% drawdown on your portfolio value in the interim, while your horizon might be long, but if you panic and start selling out of it because like, oh, I don't understand equities, let me get out, then that's a challenge, right? Then your willingness actually doesn't exist. So I think that willingness or the understanding also needs to be very, very clear. And if you set that expectation right at the start, you kind of attune yourself, even behavioral, to think about it that, look, I'm coming in, I have a 10-year horizon, I know the markets will probably be choppy, and I could see this $100 has become $50 in the short term. That's okay, because I'm going to continue to stay invested because I have that long horizon. I think that's something that in terms of understanding and psyche that investors need to build. It's easier said than done, because human emotions can play an important role. But I think that's something we should look to attune ourselves to.
Thank you so much, Kaustav, for answering that. Building this psyche is very important, I believe. And I very much appreciate the way you are answering all our queries, all our audience queries. So thanks a lot, Kaustav. Next, we have a question from Suchit. Suchit, we will take your question. But before that, I would like to ask something to Kaustav. Kaustav, when it comes to picking a mutual fund, we usually look at the historical returns and the expense ratio of the mutual fund, but one of the crucial metric, which is beta. which denotes the sensitivity of the mutual funds towards the market movement. And I believe it is very crucial factor to take note of. Can you please elaborate it a bit and suggest how we can use it effectively while choosing a mutual fund or
Sure.
picking a mutual fund?
Sure. So, Shruti, in fact, I'm a very, very firm believer that, and like the caveat always goes, right, that uh, past performance may or may not be repeated. And that's a very important point that needs to be driven home at every point of time, because when you're looking to pick up mutual funds, the first thing that you need to fix, and, we spoke about all of that planning, is that, what should your asset allocation look like? What are the types of funds, you want to buy? So, like I said, depending on your risk profile, your investment horizon, you would, ideally pick certain kinds of categories of funds that you would want to invest. After that, which is the final leg, that within that category, if I want to pick a fund, right, how should I go about doing it? And most commonly, like I was alluding to earlier, people would tend to use past performance as a metric, saying that, okay, this fund has done well, let me buy that. Now, the challenge to that is this: we spoke about cyclicality in the markets in terms of different asset classes doing well at different points of time, then different capitalizations doing well at different points of time, or different sectors. There's also cyclicality in what we call the investment style of managers, right? Let me just quickly talk about what that means. Now, there are different kinds of stocks. You would call your growth stocks, which are, which typically would display high earnings growth, high sales growth, high cash flow growth. At the same time, on the other end of the spectrum, you would have your, deep value stocks, right, which are super cheap on your price to earnings, price to sales, price to cash flow metrics. Now, there are various managers playing different kinds of styles within their portfolio. In the market will go through its cyclicality in terms of different styles coming to the fore. So if I use the classical example of 2018 to 20, the high quality, high growth stocks, that whole segment, that whole bunch moved up quite significantly, while value was a huge laggard, right? So all the funds that managed themselves with a growth bias did exceedingly well, and a lot of money came to them, right? And there are several fund houses that are very popular that run very, very well managed growth strategies. But now the challenge is, if I just purely looked at the performance and came in without understanding what is the driver of that performance, uh, you know, because growth is now in the recent times, right? If I look at 21 and year to date 22, values come back. The cycle has changed. Value stocks are doing well. The cyclicals are doing well, but the growth stocks are underperforming. So the same growth fund that was doing so well in 18 to 20, when I looked at the past 2-3 years performance, is now struggling versus the benchmark, struggling versus the peer group. And more often than not, then an investor is like, oh God, I got into this, now it's doing poorly, let me get out of it and let me go to the next one. That's not what you should be doing as an investor. Use performance not on a point-to-point basis. Use other metrics like rolling returns. You spoke about beta. That could be an interesting way of looking at it. The challenge with perhaps with assessing beta of a fund is that a lot of them would be ranging typically around that market level, or there could be certain funds that run extremely cyclical exposure that will have betas, 1.1, 1.2, and they could be a little more volatile than what an investor would want. But you should be aware of that when you get into it. I think what you need to do is a thorough analysis of, one is obviously the past rolling returns of the fund, and understand the style of the fund. I think that's very important. And there are enough tools available online which can help you. We are the proponents of what we call the style box, which will tell you that what is the traditional style of the fund. Is it value? Is it growth? Is it blend? Does it invest in what capitalization bucket? And you can decide that how you want to buy funds that have traditionally been managed with that sort of bias. I think that's a very important metric when you look to pick funds. So use past performance only as a check. Do a lot more analysis on it before buying a fund. And to an earlier question that I answered, if all of this seems very overwhelming, you think that I don't have the time or the wherewithal to do it, either use a financial advisor who will help you do it, or just buy an equity index fund. The most efficient way to buy the market.
Kaustav, I very much appreciate all the answers that you're giving us. And I believe a lot of people who have a lot of queries on this topic are getting answers. And if anybody is having any query, I would request you to please go to the comment section and ask your query. we'll be more than happy. And I believe Kaustubh will be also very much happy to answer them because he's already answering all of our question with so much of insights and like he's giving answers in an amazing way. So, Cheet, can you please come with your question? You have raised your hand earlier.
Hello, Kaustav sir. Uh,
Hi,
my
hi.
my question is that I started investing in mutual funds some 6 years ago,
Hmm.
and that time the best performing mutual funds were of either HDFC or ICICI.
Hmm.
So I started with both these fund houses, and after some 2 years, these funds started underperforming even the benchmark also.
Hmm.
And thereafter, I switched to Axis and Kotak, which are
Hmm.
performing good at that time. And now, if we consider the present scenario, I think only PGIM or quant mutual funds are performing better. So, for a long-term investor, what should be the strategy, sir? Should we keep on switching the funds or stay invested in the old fund?
Sure. So, Suchit, if I may ask you a question, are you happy with the investments or the changes that you've made in your portfolio?
Uh, yes, sir. Yes, sir. I am happy because they were performing very badly, and the AUM size was also, I think, bigger. I
Hmm.
think because of that thing, I think I did a good job.
Okay, okay, sure. So, what you alluded to, Suchit, and that's what I was actually also referring to in my earlier answer, is that so when you refer to the two specific fund houses, right? HDFC, ICICI. Now, both of these actually, for the longest time have been running with what we call a value style bias in their portfolios. And
Yes,
when
sir.
I just think about the market, right, the way it's been, and like you rightly pointed out, they did underperform, especially the HDFC pack, in the years of 18, 19, 20. 20
Yeah,
especially was a
yeah,
pretty
yes.
bad year for them. But when you look at the recent time, they've done exceedingly well. And does that surprise me? Not at all. Because the point is, value as a style was out of favor in the market in the period of 18 to 20. And Axis, for instance, runs a very quality growth portfolio. They did exceedingly well in 18 to 20. But if you see the near-term performance of the Axis funds, they are struggling because it's not
Mm.
because the funds have become bad overnight. It's purely because the market cycle is favoring value right now, right? But
Yes.
they will continue to hold. Axis will continue to be a growth manager. HDFC, ICICI will continue to be value managers. And what that will do is that there'll be at some point of time, Axis fund or a growth fund will be doing well. At some point of time, the HDFC, ICICI funds will be doing well, right? So actually, the best way of building your portfolio is that if you had, held on to some part of your HDFC, ICICI, and also along with that bought some Axis. You would have gotten amazing diversification in your portfolio because like we said, you blend the style so that at any point of time, your portfolio is doing well. Some fund in your portfolio is doing well because otherwise you'll get very lumpy returns if you're tilted towards a particular style. So I think that's important to keep in mind. Um, and like I said, you need to assess that is the manager continuing to run it in that style or not. Now, I think with quant, and because you specifically spoke about that, there is
Yes, sir.
still, the verdict. I mean, they're different. I must acknowledge. They're obviously running a quantitative framework to pick stocks, but
Uh,
there are a few, things that I would want to think about in Malabar. One is that we haven't seen their performance across a market cycle. So I would wait to build that confidence. And secondly, they're a very high churn portfolio, right? So if you see they keep switching in and out of stocks based on their framework. When they were a small size fund, they could do it very efficiently. But as the assets are growing and they've attracted a lot of assets, can they continue to do it as efficiently and generate that kind of returns? That's a huge question mark. So I would always be wary, and look to assess that before building any confidence, because it's too short to take a call. How is that going to pan out over a market cycle and as the fund size continues to grow? So I think those things are very important to keep in mind, especially for a strategy like this. There are very large size funds which have a very, very standard philosophy. If you're a 30,000 crore large cap fund, I don't really need to worry because there's enough liquidity in the market. But if you're a 30,000 crore fund that is doing a lot of trading in and out of stocks, that's a big challenge, especially if you're in the small cap space because liquidity can be a huge issue. So I think those are a few things that I would keep in mind when I'm looking to evaluate funds.
sir, is it related to directly the AUM? because as the fund keep growing, the performance comes down. Is it related, sir?
So, there have been a lot of studies that have been done globally that there is no one-on-one linkage with size. Because the point being that it all depends on the kind of strategy or the type of stocks you're trying to run in the fund, right? So if, like I said, if you have a 30, 40,000 crore large cap fund, you can trade a 10% position, not perhaps not immediately, but you can do that quite efficiently on the market, right? But if you do the same 10% of a 30,000 crore fund on a small cap counter, that's going to create a lot of havoc. And if you have a very large trading, sort of framework, say for instance, a quantitative trading framework that you keep switching between stocks, that becomes even more harder to run a large size fund. So it depends on the type of fund. So for instance, in the past, a lot of small cap funds had shut flows. They said we will not accept either large lump sum money or we will not accept any money at all, which is actually a great move because they didn't want to hamper their portfolio by getting too many flows where they could not deploy that efficiently. So I
Yes,
think
yes.
it's a factor of the type of fund and the strategy they run. So one size may be workable for a certain type of fund, but it may not be workable for others. So that it needs to be evaluated on a fund to fund basis in terms of capacity.
Yes. So for the long-term investor, these things becomes hurdles actually. We select a fund at the present, keeping the mind of present scenarios, and after some 2 or 3 years, the fund fail to perform even the benchmark also. So in that case, like, is it wise decision to switch the fund or just continue with the old fund? And in case if you want to switch the fund also, should
Mhm.
we sell all the units of the old fund or start a new SIP in the new fund?
Sure. So I think the first question you should ask yourself and do some analysis is that has anything materially changed with the fund, right? Why is that fund suddenly underperforming? And
Yes.
there could be some material changes. For instance, that say the fund manager has changed.
Sir,
And
actually the whole fund house only underperforms, or all their schemes they underperform.
correct. No. So that's exactly what I was coming at. If nothing has materially changed with the fund, right, then it's potentially just being a function of the market cycle, which I was talking about earlier. Because and I use this example of cricket. We're all a lot of us watch cricket very closely. Now imagine if you're playing a test match and you have Pujara and Pant, and suddenly you start seeing Pujara trying to come out and hit sixes. That's not ideal, right? Because he's not that's not his game style. He will block and milk runs, whereas a Pant will try to attack. Now the point
Yes.
is the different style of the two players is similar to the different style of two managers. Now, that's not a perfect example, but the idea is that as long as the manager is doing what he intended to do, and that's what I was sharing from more recent times. If you see the recent performance of the HDFC and ICICI funds, they've come back very strongly since 21 and year to date, simply because they stuck to their process, they stuck to their style, and that's paid off as the market cycle turned. Right, the same thing will apply to Axis today. So a lot of money investors loved Axis in 2018, 19, 20 because they did well, because growth was doing well. But if I
Well,
go back in time and look at 16, 17, the Axis funds were struggling then, they're struggling now, not because the manager became bad overnight, but because growth is not in favor in the market right now. So I think that's what you need to keep in mind. Has anything changed, or is it still the same with the fund? So I think that consistency is more important in the philosophy of the fund rather than trying to switch too often. Because otherwise, what will happen? I mean, imagine a scenario that you sold these underperforming funds in
yes.
2020, uh, and you bought, say, Axis, and Axis is now doing poorly relative to the HDFC fund. So you lost on both, right? You sold a fund that performed well after you sold it, and you bought a fund that's underperforming after you bought it. So I think that's the challenge you need to address. And the most efficient way of doing it is, like I said, mixed styles. Buy value and growth together in your portfolio, different managers. You'll always have a much more, at a portfolio level, you'll have a much more seamless experience.
Okay, sir. Thank you very much,
Thank you.
sir.
Thank you so much. I think you are taking all these questions to much depth, and it is really fruitful for all of us. The knowledge you are giving is so precious right now. And I would want Ashok to go ahead with his question now.
Hey, hi, Kaustav. Myself, Ashok.
Hey, hi, Ashok. Yeah,
I do algorithmic trading and I myself manage a little amount of fund for investors, but it is purely algorithmic. I do option selling and equity intraday and overnight. So my trading style is like for short-term holding only. But recently, since the thing you mentioned that these things run over a small fund size only. So I wanted to know like do fund managers, HDFC, ICICI, these guys do technical indicator based investing also, like for example, let's say Paytm, Zomato, these are good companies, let's say, but do they, let's say nowadays they are crashing. So do they mix up these technical indicators also to buy them or are they purely fundamental based investments?
sure, sure. So, most fund managers will always be rooted in fundamentals in terms of the stocks that they want to own, right? Where not necessarily technicals, but price will become important is for managers for entry points into stocks, right? So you will still want to own a fundamentally strong stock that you believe in. I mean, no one wants to necessarily own a stock that you fundamentally don't believe in the story of the business, right? But people who are more conscious of valuations will probably wait for the right price to come in to either increase exposure or enter a stock where then they'll probably maybe not necessarily use that as a guiding light, but perhaps look at some of these indicators just to get a sense of what price they want to get at, right? So it's not something that they would incorporate into their philosophy per se, but yeah, I mean that's something they could take cues from. But yeah, I mean they're largely purely fundamentally driven in terms of the kind of stocks they want to buy and businesses they want to own. So yeah, I mean that's at least from my experience with all the managers we've spoken to, that's largely been it. There are quant shops globally that can and do run these kind of strategies, but in India that's not so prevalent yet.
Okay, I have one more question. So let's say I start doing investments and I have built up a portfolio of let's say 1 CR or 2 CR. But at some point, there's this negative Q going on in global markets, maybe recession, war, whatever. So ideally, I would want to hedge my portfolio. So what's the best way? For example, two, three ways are either buy a put option for Nifty or maybe short call OTM for indexes like Bank Nifty, Nifty. Are there any other ways and what would you think like which one is the best way to hedge your portfolio?
Yeah, the biggest challenge with, the hedging your portfolio. I mean, if you're an equity investor and you have a long-term horizon, I wouldn't worry so much about the short-termism. The one way I would probably express it when we think about a portfolio construct, right? That if my portfolio value is say gone up from 100 to 200, and I had a certain asset allocation in mind that look, I want to own 80% equities and 20 in fixed income, which can be kind of a steady state of my portfolio. But because the equity markets have run up and that 80% in equities has probably become 90%, the one thing you would probably want to do is bring that down back to what you call strategic levels of allocation. You might even want to express a view of saying that look, valuations are very expensive. Perhaps tactically I'll reduce exposure, but tactically you will always operate within a band. So you will look to reduce exposure maybe by 5-10%, right? So your 80% might come down to 75 or 70%. You won't take it down to zero if you have a long-term horizon, right? So I would ideally, I mean, there are obviously great ways, you could do covered calls, to buy a put, but the challenge is that, this is only for a very, very short period of time, which may or may not necessarily always play out. I mean, yeah, I mean, uh, you know, there's no necessary benefit of doing that on your portfolio unless there is a very urgent need for that money. And if there's an urgent need for that money, I wouldn't be in equities at that point of, I would be taking my money out and be sitting in a fixed income asset class, altogether. So I think that's important to keep in mind when we think about, hedge or not, at least for an average investor on the street.
Yeah, makes sense. For an average investor, it might not. But I personally, given that look at markets actively, that's why I wanted to know. So yeah, that's great. That answers my question. Thanks a lot, Costa, for answering my questions.
My pleasure, Ashok. Thanks.
Thank you so much, Kaustu, for answering this, and thank you, Ashok, for asking this question. Actually, we are very much short on time, so I would like to ask Kaustu for how long he can answer, like he can stay with us, because I see a lot of people are very much enjoying the session, and everybody is asking their questions, and they are very much everybody's enjoying asking a lot of questions to Kaustu, because Kaustu, you are also on the way you are responding to all of us. We very much appreciate it, and thank you so much for this.
My pleasure completely, Shruti. So perhaps I mean we could do another maybe a couple of questions if that's that's okay.
That's great. Thank you so much, Kaustu. Kaustu, I have a question I wanted to ask. We often hear that tech sector of the US is doing better than India, and so is it a good option to invest in the US based index mutual funds like Kotak, Nasdaq 100 funds to diversify our portfolio?
That's again, I think, a very important point, Shruti, because I think traditionally Indian investors, at least for the longest time, had what we call a significant home bias, right? And there are various reasons for that. But a bulk of our investing happened in the Indian markets and the Indian equities. Obviously, there are reasons like capital controls, and it's not that easy to invest in. But I think what's happened over periods of time is that obviously now there are options available, and hopefully the limits that the industry is struggling with right now in terms of the overseas allocation that they can make. RBI does allow that to open up, and but that aside, you know, we think in terms of, so we talk about diversification, global asset classes such as, be it the US or large developed markets can definitely help in, diversifying your portfolio. And again, history has shown us this, right? There were times where the US markets relatively were doing a lot better than the Indian markets. So, that was in play. This year, obviously, relatively, the Indian markets have outperformed. But the whole point is that you need to be invested in both these, several of these markets to actually enjoy. Again, we spoke about styles of management. Here's your geographical diversification, right? That you can bring that in by investing in different geographies, different economies, and kind of de-risk yourself just from Indian companies. And the good thing is now there are a lot of options available, like you said. A whole bunch of US actively managed and index funds, and exposures to other geographies that you can take through the domestic route, which would then eventually go and invest money for you abroad. The only advice that I would give is don't do the same mistake in terms of coming too late to the party, right? And we've seen this time again in the market, but I think there's maturity coming in. Because I'll take you back in time in 2014. So before we had the sharp run up in the Indian equity markets, the markets were flat to negative for a very long period of time, and that's 2013 was when we had a fairly good run up relatively in the US markets. Post that, a lot of money came into US mutual funds. Most of them were actively managed from Indian investors, right? We had a few options then. And then you had the sharp run up in Indian markets, and relatively Indian markets did substantially better. And then investors just forgot about the US markets and purely stayed invested in Indian equities. And again, then you had this sharp relative outperformance of the US markets the last couple of years until late last year. But investors were again late to the party. So I think you need to be invested in that asset class to make money in the asset class. That's the moot point. So don't try to chase that performance that this category is done well, and let me invest in it today. You need to be invested in that category to enjoy the returns that it provides, rather than trying to chase that performance. So add that element of geographical diversification. Thanks for bringing that up, Shruti. I think that's a very, very important perspective to share with investors.
Thank you so much, Kaustav, for answering that. It was really insightful, and it helped me understand. I have one last question, which is very important for a lot of people, I believe.
Mm-hmm.
And the question is how to choose ELSS mutual fund while saving tax under ATC. Am I audible?
Yes, you are.
Kaustav, are you there? I think there is some kind of a
Yeah,
glitch.
sorry,
Okay.
I'm back, guys. Sorry. Yeah.
Okay, so can I repeat the question,
Yes,
Kaustav?
please.
Yeah, sure. So the question is how to choose ELS's mutual fund while saving tax under ATC.
Okay, sure. So again, I think what's important is the same tenets of fund selection apply, be it to any diversified equity fund, and similarly for ELSS funds, for any fund for that matter. What you want to do is look for consistently managed funds within that, and mind you, when I say consistently managed funds, means in terms of the style of management, uh, and kind of buy into them and stay invested. So typically there's a lock-in of just 3 years, but ideally you can just stay in. I mean, it's as good as any diversified equity fund and ELSS. So you would want to do some rolling return analysis to see the funds that have done well on a rolling return basis, but also peg that with looking at the consistency of the style of management, look at what the pedigree of the fund manager is, who's the team backing him, and all of that help you make that choice in terms of, which is the LSS fund that you want to buy. Typically, you would just, compare that with any other diversified fund that fund house is managing, and you'll get a good sense of where the strengths of that team lies.
Thank you so much, Kaustav. I will ask you one question from the comment section.
Sure.
A learner is asking how to find a good fund manager, but along with this question, I'll ask you how to check factors like stock allocation, whether it is concentrated or not, along with a good fund manager, and also what kind of AUM should a fund has or have to have. So this is my question to you, Kaustav. Yeah.
Sure. So when you think about a fund manager, right? So I think we need to first think about looking beyond just the fund manager, and that's a very important sort of thing to analyze. Because see, the fund manager is the face of, and obviously he's a very integral cog in the wheel in terms of managing the fund. But remember that he's being aided by a team that helps or enables him or her to make that the right decisions, right? So if it's an equity fund, you would also not just look at the pedigree of the manager in terms of his experience, how the strategies that he's managed in the past been doing over long periods of time, but you'd also want to see, what is the endless resources that he has at hand. And a lot of this information is actually available through the fund documents, where you can take calls in terms of the pedigree of the team that's backing him. And traditionally, not only would we want well-resourced, well-experienced teams, we would also want teams that have traditionally tended to work together for a long periods of time, because that's something that we've observed. When teams have been working together for a long period of time, there's a fair bit of cohesiveness in the thought process, and that really translates into very efficiently built portfolios. So that's the first thing in terms of when I think about the people side of, how do I, assess a fund manager. And obviously, you would want to look at his or her track record, like I said, in the funds that he's managing, and is it similar to what this fund he's managing, right? So if the track record's based on erstwhile large cap funds that he managed, and he's only recently started managing this fund, which is perhaps a small cap fund, I might not build that much confidence. But if it's a very similar strategy that he's been managing for a long period of time, and it's done, well, and it's been consistently managed, then yeah, and that's how I would look to assess the people side of things, right? But just not the fund manager, the team also. Your other question about it was about AUM and stock concentration. Now, see, there are a couple of things when we think about. There is no optimal level of stock concentration, but rather what I would like to see, and both of these could go hand in hand, is that there are managers who run and have traditionally run very, very concentrated, or reasonably concentrated portfolios from a mutual fund context, 20, 30 stocks, and they've done that very successfully, because that's how they manage to size their positions and take their big bets in the portfolio, and they've done that quite successfully. But if I see that same manager suddenly adding, going from 30 stocks to 40, 50, 60 stocks, that becomes a big question mark for me. Because is that because the size is growing, capacity is becoming an issue, and they need to add more stocks, and that could dilute the portfolio and the way that the manager or that strategy was being managed in the past. The same thing would go for typically a manager who, there could be managers, and there are a lot of good managers who run more diversified portfolios. They like to take some large bets at the top, but want to, create a slightly longer tail. And there could be various reasons of doing that, taking, their second, third conviction bet within that. And they've been consistently getting the results running that. So I would want to see again consistency of the way they've managed it, and if that's okay, then I'm not fixated on a particular number, but rather the consistency in the way they've kind of run it around that. And if there's any deviation, we'd want to understand, is that deviation intentional or has it been forced upon them because the AUM has grown, right? And specifically about AUM, there is a lot of misconception that smaller size funds, yes, they are potentially more nimble, but remember, economies of scale also kick in on several factors, right? That when you have a larger size fund house with larger assets, it helps you build more analytical resources around. Uh, so we've seen large funds also do exceedingly well because they have the backup of great analytical resources. But yes, if fund size becomes a factor in terms of that the fund cannot be managed in the same way because the fund size has become too large, then that is a concern, right? So that's what we need to keep an eye on rather than just a pure number. So I think that's the way I would look at asset sizes of funds. And I'm happy to report that there's still a bit of, I would say there's still a long way to go in terms of at least the larger funds or the more prominent funds becoming problematic. I think the issue with size is probably now a little more apparent in, say, the small cap funds, and a lot of them have taken prudent measures and reducing or only inviting, say, SIP flows or stopping of flows entirely, which is I think great practices.
Thank you so much, Kaustav, for this explanation. And now I have a question for you, and then we'll take Suchit's question. So I have this question for you that most young people they like investing in cryptos for like various reasons. But what is
Right.
your take on the same? How much of portfolio should I allocate towards crypto? I'm so sorry for this crowd's favorite subject,
Sure.
so I wanted to ask.
Sure, sure. No. Thanks, Rich. I'll be very honest and blunt. I'm a dinosaur when it comes to cryptos. So I do not have a specific view on cryptos at all. And I'll be honest, I don't understand it. See, I think the technology is great, right? The challenge for me, and where I struggle is how do you intrinsically value cryptocurrency, right? Because as an application, it's great. As a platform, it's great, but this the euphoria that's in terms of price movements that it's created sometimes can be quite damaging to an investor because that's seen extreme price swings and that's purely been driven by a lot of demand and obviously very very limited supply given the way this works. That has been the challenge from my perspective, that what is the intrinsic value. Like, you could potentially at least derive intrinsic value from other asset classes, but what is the intrinsic value of crypto? That's where I struggle. So I would think, I don't understand it at all, so I'm not invested in cryptos at all. But if you want to take that, think about what your risk capital is, where even if you lose 50, 60, 70% of it, you're not going to lose sleep over it. Allocate that much. But if you have the resources and you understand that space better, then by all means you can allocate more. But I don't understand it. So yeah.
Thank you, Kaustav. I went to this conference, that Morningstar conference, and I asked every fund manager about this, and all of them were like, "No, we don't invest in crypto." So it was very very clear from their side as well. So we have two more hands that are raised. If Kaustav, you want to take it, we can. But if you're running out of time, we will stop it here. It's all up to you, Kaustav. I'm
No,
sorry
sure.
to
Let's
put you in
let's
the.
take these last two questions and then we can call
Yes,
it.
yes, guys. So we'll keep it very short, Suchit. Yeah, go ahead.
Kaustav, sir,
Yes,
uh,
Sachin.
there, are, there are some reports stating that the Nifty 50 equal weight index actually outperforms Nifty 50 index in the long run. So, what's your view on this?
Yeah, that's Suchit, that's a very interesting observation because traditionally, when you think about the way index creation happens, and this is again, this is not entirely true at every point of time because
Yes, sir.
while
But in general, in the long run, like
yeah, sure.
5 or 10 years.
Sure. So, there are pros and cons of that. Uh, so the whole point being that, I mean, again, it's kind of a rules-based index, right? When the only rule is that it's buying the index stocks, but buying it in an absolute equal weight, and most traditional indexes are, market cap weighted. So, your bigger companies would tend to have, higher allocations within that. So yes, intuitively you would think about it that in the long run it can perform better. But there have been times in the market where your large cap companies have delivered, or your larger companies have delivered much greater returns than. Uh, so it is a function of at what time you enter and exit, but you can potentially the beauty of these indexes, right? You can create positions in stocks without actually doing too much active management by just doing this equal weighting, right? So you can, if, by if you want to tweak or you want to make your own sort of custom index, so to speak, you could actually potentially even just run that through a Nifty plus Nifty equal weight index in the proportion you like. Now it's not exact science, but you can do that to actually create almost like a custom index that you feel comfortable doing. So that's what a lot of these what we call this is one variant of a smart beta could help you do that. But I wouldn't bet all my money on it, even if I was entering an index fund. But yeah, I mean, it is definitely an interesting space to look at.
Yes, sir, because we get to buy the value stocks, sir, in the Nifty 50
Right.
section.
Absolutely.
Oh, okay. Thank you, Suchet, for asking that question. Yeah, we will go to Ashok. Yes, Ashok. आप पूछ सकते हो question.
So, Costa, my this question is an extension to previous one only.
Sure.
So, as you mentioned that some fund managers use like indicator-based entry, but they do fundamental analysis also. So, let's take an example. For example, a fund manager might have a belief that Paytm is gonna do good in long run, but he might be waiting for some kind of entry point. So, I wanted to know, are there any popular entry points? One example is, let's say, if it comes at a 1 year high, then only I will buy or something like that.
Yeah. So, Ashok, what I was trying to say is that I mean, that's not something that they will look at it, but that's not a final decision making point. I mean, they're more fixated about what they think is a fair price to buy the stock at, right? And obviously they look at some of these indicators. A lot of fund houses are also using some bit of quant analytics to help them do that. That perhaps this is where a stock price is gravitating towards, but that's not going to be the sole decision making point, or in fact even a trigger to buy it. I think what that will help them build is probably that, okay, if I'm I wanted to build a 5% position in a stock, maybe I can, once it's reached a certain level, I will start sequentially building that up. But technicals won't really play a very, very integral role in their decision making. It's more about, how do I, have I kind of come close to the price I want to buy it at, is what I was kind of alluding to.
Okay,
Thank you.
got it.
Okay. Thanks, Ashok, for asking that question. And I think we are done with the space. Kaustubh, thank you so much. And everybody really enjoyed this session. And सबने बहुत सारे questions पूछे. It was an amazing session. And Kaustubh, आपने सारे questions इतने अच्छे से answer किए. I hope हमने आपका dinner skip नहीं करवा दिया होगा.
नहीं,
Because
बिल्कुल नहीं. I really appreciate you calling me for the session, and thanks for all the insightful questions. To all the listeners, and Kalyan, Shruti, Racha, thanks for calling me on. I think this was a great interaction. Really loved talking to each of you.
जी. And Kaustubh, is it your first space, Twitter space?
I as a solo uh, speaker, yes, I had done one, in a bunch as a speaker, but that was a very short period of time, a few months ago. But yeah, I mean, as a as a primary single speaker, definitely, and a very, I initially thought that how long will this potentially go, but it was so engaging. Like you said, we could go on for a few more hours. But
Exactly.
yeah.
Exactly. And people actually loved you. And अगर आपको अच्छा लगा तो do follow Kaustubh. And of course, I'm sure Kaustubh यहाँ से Twitter Spaces में और आते रहेंगे. And we will definitely try to bring him back because there are so much things that we want to ask him. And yeah, Shruti, you want to take over?
Yes, definitely. Thank you so much, Costo, for joining us today. And thank you so much, everybody, all the people, everybody who have joined us today in the audience. Thank you for being such an engaged audience. Thank you so much, Costo, for being there. Actually, we kept asking you a lot of questions because the topic was very much interesting. And like the way you were answering all of them, we had a lot of questions. So, like, we were not able to help ourselves. We kept asking you, but thanks a lot for your time. We very much appreciate you joining us today. And apart from that, I would like to thank every single one of you who have asked your queries. And then Kalyan and Richa, thank you so much for hosting this space with me today. Richa, would you like to say something?
Yeah, thank you so much, Kaustubh. I mean, it was a really nice and really wonderful space, and I really learned a lot, and I'm sure all of us must have learned a lot. Also, thank you so much, guys, for asking your questions. It made the space really interactive and it came out really well. Thanks a lot, everyone.
Thank you, Richa. Thank you, Shruti. Cost of any final words that you want to talk about?
Uh,
Anything in
no, I
particular?
mean just thanks, folks. Thanks to all of you all for being very very patient listeners and great questions. I really enjoyed this session, and I think I'm so glad to see that everyone's thinking about investing and starting early. Which is exactly what we want to hear. That everyone can have a great financial journey. So good luck, and thanks for your time today.
Thank you, Kaustav. And we will be back with the third episode of Let's Grow Together. And we are bringing in another amazing guest. And thank you so much. You have been an amazing audience. And with this, I will close this session. Thank you so much, guys. And the recording is also available, so you can listen it back if you want to. Thank you, guys. And I am closing this space in 3, 2, 1. Bye, guys.